Hello and welcome to episode 203 of the Money to the Masses podcast with your resident expert as always, Damien Fay, and me, Andy Leakes. Damien, I'm feeling festive, and what always comes with the festive time of year, I get my festive chest infection. So apologies if I'm sounding a little bit, well, some would say hoarse, some would say sexy, but yeah, you're stuck with me. How are you doing anyway?
I'm good, Andy, because I suppose I can't say it's a positive of Crohn's disease, is that you get a free flu jab to try because your immune system becomes suppressed. So I hopefully will miss this flu period, as I do most years. So yeah, I'm sounding a lot better than you do, Andy, but you will soldier on, no doubt.
Yeah, absolutely. Are you feeling festive? We're a couple of weeks away for those that are listening in the future thinking, why are they talking about Christmas? It's the middle of May. It is Christmas almost at this time of year.
Look, this year I've somehow managed to get to December the 7th it was without hearing a single Christmas tune, because I've had my head down, properly head down, working on some stuff that's going to be revealed shortly on the new revamped Money to the Masses website, and a new tool that is brilliant. That's a lot of work's gone into it in terms of tech and outside agencies we've involved into doing the development and design, and that I can very soon share with you. So there's been a lot of work. So I've had my head down and I've not been listening to Christmas songs, and so yesterday I put Bublé on. I got his Christmas album out on Spotify and listened to that, so I've become a little bit more festive. We're not full beard, tinsel and baubles yet. We're just one step up from the Grinch, but I am looking forward to Christmas and a nice break anyway.
On the Christmas thing, I suppose I've got to ask you, have you got it up yet? And when I say that, I mean the tree, of course. And if not, or if so, do you have a specific time of the year that you do it? We have a kind of an argument at home as to when is the perfect time.
I do it 2 weeks before. I think that's normally enough. But last week, I haven't got it up yet. And last week was the beginning of December, wasn't it? It fell on the weekend and I almost gave in, but yeah. I was too busy. But the problem is I have two cats as well. So cats and Christmas trees, they're like arch enemies, aren't they? It's like the nemesis of the Christmas tree that the cat will... You can see them like walking past and just almost...
That's a tree and that's indoors and that needs to be climbed.
And almost flicking the bauble with the tip of their tail as they walk past. And then you go in and you just find baubles and tinsel everywhere. So, yeah, it just means that I have to be on my guard a little bit more. So I want to minimise that period. But
on that, I know we've got to get on with the podcast. We will do so in a second. But have you seen the cat-proof Christmas trees out there? Have you seen it?
No, is it wrapped in tinfoil?
No, what it is...
My cats hate tinfoil.
It's basically a huge stalk of a tree, just literally the trunk, and then just the top maybe third is showing. So there's literally only like 3 or 4 sort of levels of leaves. So basically it's a bare stalk and then a little tree at the top. It looks horrendous.
See, my cat would just think it's a funny looking scratching post.
Yeah,
I'll run with that, but anyway.
What have we got coming up on this week's pod?
Well, I've got a big investment piece which people will be keen to hear, because one of the distractions in the last week or so is markets have been going bonkers. And anybody who has an investment portfolio will be, if they've looked at it, will be thinking, oh my God, what is going on? And you will even have seen when you see news pieces get on the 10 o'clock news or the top story on the BBC that the FTSE 100 has lost X amount of billions and the worst day in more than 2 years, you know something's going on. So I want to talk through that, but in true Money to the Masses podcast fashion, I want to make it evergreen. I don't want to... It's very contemporary, but if you're listening to this in the future, there will be little bits in it that are just more learnings as well. There's a couple of investment questions that I promised I would do this week that I was asked previously. And finally, it was the myths on plane prices. So if you're going to book an air ticket, you want to go on holiday, there were some myths that I was going to talk about last week that I didn't manage, and I'm going to squeeze them in this week.
Good. We've been promising that for a couple of weeks. Okay, so I suppose the elephant in the room, we must cover what's going on in the markets. It's been a crazy, turbulent week. And we've talked in the past in previous podcasts about the Santa rally and what that means and stuff. Is this kind of going against what we've said in the past? I mean, isn't the Santa rally normally a good thing leading up to Christmas? It means that markets are going in a sort of fairly positive sense.
Yeah, the Santa rally, for anyone who doesn't know, is just this phenomena that occurs regularly, and it's pretty much nailed on almost 75 to 80%, depending on whether you're looking at US or UK equities, where there's a tendency for the stock markets to rally into year end. Now, some of that is just, I think, euphoria and a little bit, people feeling a little bit Christmassy. Some of it's down to the fact that traders end up trying to boost their portfolio performances, and there's a number of theories is why it occurs, but it does tend to occur quite regularly. The time frame is also up for debate. Some people say it starts from early December, some people say it's just the last couple of days in December into January, but there is a tendency, a seasonality of stocks that does exist, and I've done the research for 80/20 investor members to show it does. It's not to say it's not going to happen, but at the moment, if you were to look at the stock market, we've had some pretty horrendous days. We had days in the last week where the market has been down more than 3% in America, in Japan, UK. But interspersed with that, we've had some absolutely epic up days where we had the US stock market rally 4 to 5% in a matter of days last week. And of course, everybody then got the party poppers out, their Christmas jumpers on, their Santa hats on, and said, yup, here we go, Christmas, the Santa rally. Now, the market has been spooked lately. If you go back to October, one of the biggest things that spooked the market was the idea that the Federal Reserve, the US Federal Reserve, which is the equivalent of our central bank, our Bank of England. So the American central bank has decided that it's going to start tightening, or confirmed it's going to continue tightening, I should say, monetary policy, so raising interest rates. And it seemed to be pretty hell-bent on doing that no matter what the economic data was suggesting, because the economic data over there was suggesting that the US economy is continuing to boom. Eventually, that spooked the market. We did a podcast on it. It digested the meeting minutes. It sort of threw up everywhere, and the market just decided that it tumbled. Now, there was a period where we've been since sort of early, mid-October really, the market's sort of zigzagged up and down, and we've been getting some nice shapes in the stock market. We even had a nice forming of a W, like a double bottom they call it. It looked like that we might then bounce back to all-time highs. The problem with these patterns in technical analysis is they only are confirmed after the event, so
yeah, sure.
They're not predictive. So you look at it and people are going, oh, here we go, this is definitely a bullish sign, we're going to go back up.
And by the time you got to that point, you're already on to the next phase.
Yeah, and that's great for day traders. They love that stuff. If you're a long-term investor, like most people who listen to this podcast, then those sorts of things just will show maybe a general trend to be aware of, and hopefully that will turn into a more sustained trend. But what we had is the central bank tightening, and that then eventually got everybody worried, because don't forget, the bull market has mostly been driven over the last 9 years by easy monetary policy by central banks, basically low interest rates and money printing, which starts to boost all the assets out there, asset prices, from you name it, house prices to stocks in particular. Now, the other thing we had trade war tension. So Donald Trump, he's actually called himself Tariff Man, a bit like Iron Man, but focuses on tariffs the other day, and he was starting trade wars with everybody, particularly China. And of course that has a negative impact, or potentially negative impact, on profitability of companies and economic growth, because if you start whacking tariffs on everything, it puts prices up, and it means it impacts the amount of things people buy, and it impacts the economy more widely, because you imagine if they import stuff from China and they need to build things, then it's going to cost them more, etc, etc. We've done a podcast on that. Go back and find it. So we're at the period we had these two big headwinds. There were other smaller ones in the background, but they were the two major ones, and they kind of came together, and it caused the market to sell off. Last week, so we're going back the week after Thanksgiving in America, with the market showing signs of weakness and struggling to get above the sort of 2,800 level on the S&P 500. I've been talking about those levels quite a bit. We've been a bit range bound on stock markets. They've been bouncing up and then falling back down again. It's the buy the dip mentality, which is whenever the markets go down, you just blindly pile in. You're getting it cheaper. You pile in. Over the last 9 years has always worked, partly because central banks have had your back. Now that's been shown, that's starting to fail, and it's going to be the first calendar year likely where that, for 9 years, where that strategy has failed. So actually the opposite to that is sell the rally. So whenever it rallies, you then sort of sell into that. So you sell into strength, because you're closing out positions as they get higher. We're getting into that world, and that's when you start hearing things like bear markets. Basically the trend for stocks is generally down. We haven't got confirmation whether we are in a bear market yet, but the signs aren't looking great. Now, they were the two big headwinds, and what happened is that last week, the Federal Reserve, Jerome Powell, he's the equivalent of our Mark Carney, became dovish. So he started sort of suggesting, oh, actually, I might not raise rates as quickly as I planned to. Then the market went, woohoo, and was euphoric. The market jumped. Then Donald Trump went to the G20, sat down and had dinner with China, and they came out saying all wonderful things on Twitter, suggested there was going to be a trade war truce. The market went mental.
When you say he had dinner with China, do you mean like he ate on China plates, or he actually met with someone from China? I'm assuming the latter.
It's it's President Xi. It's the whole Chinese administration and the Trump administration sat down at an enormous table and tried to come to some sort of agreement. You're never going to decide anything over dinner. You know, Andy, you had your dinner party last week. I don't know what was happening there, but I bet you there was no sort of groundbreaking trade truces or anything like that. I bet you couldn't even agree on some sort of Brexit or anything like that, or what songs are going to be played.
Now is certainly not the time for the update on that. We're in the middle of a really juicy, interesting piece. But nothing was decided, but there was some politics spoken and quickly forgotten about. So sorry, carry on.
Yeah. So what happened is they gave the sense that relations improved. Well, Trump being Trump can only go about 24 hours without firing something on Twitter, and quite quickly that soured. There was also, you may have seen, a lady, the CFO of a big Chinese tech company, was arrested and is probably going to be extradited to America. Was arrested in Canada under the direction of the US authorities. To give that some context, that's a bit like, say, the daughter of Tim Cook. So Tim Cook, who's the CEO of Apple, it's a bit like his daughter. Let's imagine it. He had a daughter, and she was also the CFO of Apple, being arrested somewhere in the Far East to be extradited into China for maybe doing business with Taiwan or something. And of course, you could imagine that the people in America would be looking at that frowning. So China aren't particularly happy about all this latest development. So the trade war tension suddenly rose again. And what we saw was the market go from rallying ridiculously hard to collapsing overnight. Some absolutely mind-blowing falls, 3% in a day on pretty much any stock market you cared to see. The other thing, though, in the background of all of this is that they all have contributed to some way or other the fall in global growth. Now, the global economy is slowing, and one of the underlying reasons that we've had this sell-off is not just because of the tariffs and the Fed tightening. It's because the world economy and the US economy is actually starting to slow. The growth rate is actually slowing down. And it's the Fed and central banks looking to tighten at that same time that's causing this hiccup. The trade war is probably going to be exaggerating all of this. And it's quite timely because we did a podcast on the yield curve, didn't we, Andy? We talked about the yield curve and we talked about spreads and things like that. Now, that is actually, this week, has been very sort of fortuitous in terms of understanding, but the yield curve inverted and a certain portion of it in America. So what that means is that the yield on loans, so treasuries to the US government, were higher in the short term at 2 years. So if you lent money to the US Treasury for 2 years, you would have got a better yield than if you lent it to them for 5 years. Right. That is counterintuitive. If you lend money to somebody for longer, it's more risks. You expect a higher yield, a higher interest rate. So the reason that's a sign that people think a recession's coming, because in a recession, holding things like bonds is actually a good thing, which actually drives down the yield. All you've got to focus on is it's a lead indicator that's fairly reliable that a recession may be coming. And that really spooked the market, and they flew into buying treasuries en masse, sold out of stocks. We had this absolute carnage. And the reason that it's very interesting is because if you look back to, there was lots of parallels being drawn to 2008 in terms of some of the falls or the levels of volatility and stuff like that. Now, let's be clear, the market has just gone back to the lows that we already experienced in this year. So it's about where, again, at a turning point, do we break below that and that gets serious, or do we bounce back higher? But what is interesting when you look at all this is comparing the world to 2008. Now, lots of people have been saying, it's all the debt and leverage. Well, that's exaggerating the moves, because the moves are quite wild. That we've seen, for example, 3% moves this year in the S&P 500. this year alone, 3% in a day I'm talking about, which is high. That's way more than normal. And it's not because of the amount of leverage in the system. It's not because of people are borrowing money to invest like they did in 2008. There's something else that's more at play, and this is where it becomes more sort of evergreen. We've got to the world where algorithms, in terms of, when I say that, I'm talking about automated trading systems, are having a huge impact. If you go and look at your stock app on your iPhone or whatever phone you have, go and look at the movements during the day. You will see there were points, say on the S&P 500 in particular, where the market was going along, and then when it was bouncing along a certain level, and then once it broke, it then plummeted. Now that is we talk about technical analysis and key support and resistance levels in the stock market. So when it goes below a resistance level, it might break down to the next one, because that's when people then suddenly rush in to buy again. But what's been happening, there are signs that these computer trading systems en masse are automatically, when they get triggers, starting to just unwind and sell everything. And they see certain levels, and once they're hit, you get mass dumpings of stocks on the stock market in America. And it's exaggerating the size of the moves downwards, if that makes sense. So if you imagine previously, there would be, in years gone by, there would be where algorithms perhaps had less, or the automatic trading systems, I should say, had less of an impact on markets because they weren't as big and wasn't as much money flowing through them. And they're run by these sort of hedge funds or institutional companies. Then in those days, you would have had human traders trying to pick up the opposite side of the trade, thinking, oh, that's a good value, I'm going to buy in. Well, what's happening is once one of these automatic trading systems starts selling, it triggers some others, and they then start all going at the same time. And don't forget, these are all being programmed by humans who are using the same assumptions. And of course, the other problem we have in the world where we program things is that there's an over-reliance of data that's very recent. I saw a statistic, and it's probably made up, but it was a stat that was quoted, I think, it was in one of the American media channels, that about 90% of the data that's out there was only created in the last 2 years. So if you think all the data that's flying around, prior to the last 2 years, most of it probably wasn't online, or it wasn't in any way being captured. And of course, that also exaggerates things when you're thinking about computers that are making decisions automatically based on data they've got. They've got very small time frames. So the reason this is interesting is because it's causing the market to unwind rapidly. And then, equally, it's being manipulated back the other way, because these algorithms and computer trading systems are watching for signs on social media even. If Trump starts tweeting about positive things to do with China, you will suddenly see them start buying back massively. And what's interesting are people are moaning about this now. You're starting to get some people in the trading world complaining about these trading systems, yet they don't seem to complain when they go up. When they've driven the market higher and ever higher to new highs, they're happy. It's only when they start losing money that they have a problem. And so these are being manipulated in some ways. You go and watch. If you go back to, when you're listening to this podcast, if you go back to Thursday evening, when the European markets closed, the US markets suddenly rallied. And there was a Wall Street Journal story that seemed to be conveniently placed that was talking about the idea that the Fed now wouldn't actually raise rates possibly at all. And there are some that question where that came from and what were the sources of that. And it was very timely, because then it caused the automated trading systems to go into reverse and start almost panic buying. And so why this is important is, as long-term investors, I've just done a really interesting research piece for 80/20 investor members about how often you should check the value of your portfolio and the impact it has on your perceptions of reality. Because you end up, if you check your portfolio, the frequency you check actually can start to skew your view of how well you're doing, irrespective of actually how well you're doing, if that makes sense. Two people checking their valuations at different times will end up having different perceptions. And what it means is that if you check too regularly, you become obsessive about it, you're starting to see what these algorithms and automated trading systems are doing. This increased volatility we have now, you're starting to experience that far more.
And the likelihood is you'll become part of that problem as well then.
Yeah, because what will happen, aversion to a loss is greater than the equivalent gain. So if you were to lose £10 compared to gaining £10, the emotional impact of the loss is far greater than the equivalent size gain. So you're more likely to make an emotional decision based on that. But also, because of anchoring, which is whereby you place the answer to a question can be influenced by your previous exposure to a number. Now, in investment world, that can be the price at which you bought an investment at. So you anchor on that. So rather than judging whether something is actually any good or not, you're just focusing on whether it's above or below that price you bought at, if that makes sense. So it can actually start to skew people's view. Rather than just going, is this investment worthy of holding? They look at, well, am I up or down from the day I bought it? And of course, that can then start to skew your impression, because let's be honest, if you think about certain investments, you bought it just so happened to be near the top. It could be you may have lost money, but anybody else who's held it for a period previous to you may be massively up. It's just, that's what anchoring can do. It can make you start to make decisions based upon a number. And of course, if you keep checking your portfolio obsessively, especially during periods of extreme volatility, it's not burying your head in the sand, because you can make a review of portfolio at periodic points in time that's actually non-emotional. But if you'll just keep checking it and going, oh my God, it's up today, oh, it's down tomorrow, and all this sort of stuff, if you keep doing that, you are being influenced more by chance and more by what these crazy algorithms are doing, and that are being manipulated by the powers that be as well. You're more likely to make an emotional decision and a bad investment decision as a result. So that's what I want people to take away from it. In the background, one of the things I want to mention to people is that when we look at what's going on in the world, and we look at Trump, and we look at the trade war, and we look at what the Fed are doing, and all the other things that are out there, Brexit, the underlying trend or the problem that is really spooking markets is the fact that global growth is starting to slow. So we're actually not growing as quickly as we were, and actually in some places we are pretty much, well, I'll say some places, a lot of places, we're starting to slow down. And I want people to, next time you see a story that talks about whether it's growth in the UK, America, in companies or companies' earnings, or how many sales they're thinking of doing, look at it objectively and start to tally in your head how many of them are positive and how many of them are negative. Don't go seeking them, because then you get the other behavioural bias, which is confirmation bias, where you only look for the things that confirm your existing view. Just start when you see a story about, let's say it would be UK growth numbers are reported, see whether they're up or down. And what you're going to probably find is you're going to start seeing or noticing that the general trend is for all of this stuff is starting to slow, whether it's China, whether it's the UK, whether it's Germany, whether it's America. There are signs everywhere that global economic growth is starting to slow. And that's also reflected in the oil price. You will notice the oil price, you'll see headlines about it collapsing 30% in a month. These are all reflections of that. And I think what we're getting is really in investment markets a realisation that the party time in terms of expansion in global growth has actually started to disappear. And where central banks are having to possibly tighten going forward because of things like inflation, that combination is pretty volatile. It's like putting water and electricity together. It's pretty explosive. So going forward, what does that mean? You're probably going to start to look for signs of things like the dollar doing well, or bonds, particularly treasuries and gilts doing better, and defensive stocks, things that aren't exposed to the UK or global economy. So things like healthcare, drug companies, tobacco companies will start to relatively outperform. They might still go down, but they'll do better than things that are exposed to the ups and downs of the UK economy, like retail. Healthcare is another one that should relatively outperform. So there you go, Andy. That is the contemporary piece on the market. Keep an eye out. The Santa Rally may happen into the year end. It's still a phenomenon that does exist. Even in years where we've had sell-offs like we've had in December, we've had a bad December so far, but there's been 3 occasions in the past where that has occurred. Each of them are associated with very bad events like the financial crisis, the dot-com bubble bursting, but they've all ended up having fairly decent end of December, so the closing into the year, I should say. So something to watch out for. Before we move on, Andy, I just wanted to quickly mention 80/20 Investor. Now, 80/20 Investor is my DIY investment service. Do go and check it out. I empower and teach people how to invest their own money. The service provides data-driven fund tables. The data is driven by my own unique 80/20 Investor algorithm, which I created. You also get stop-loss alerts, you get research articles and insights, you get market commentaries, monthly commentaries and DIY investment lessons, but you also get access to my £50,000 portfolio, which is a portfolio of my own money, which I run live on the site for members to see, and it shows people how I use the service to maximise my returns. And in the first 2 years of doing so, I turned £50,000 into £59,500, which is a 19% return, beating investment managers, professional fund managers, financial advisors, investment banks, passive trackers in the market. So everybody can have a free 30-day trial of 80/20 Investor, and you can claim that by going to moneytothemasses.com and going and clicking on the 80/20 Investor hyperlink at the top of the page. So go and try the service. Let me know what you think of it, and I know from the feedback that you're going to love it. But for now, on with the show.
Okay, so we're not quite finished on the investment side of things. We've got a few investing questions that you've received, and you're going to answer those questions now, Damien.
Yeah, these are a couple that I'd received and I'd promised to answer, but they've actually will be interesting for the wider audience out there. Now, the first person was Jason, sent me one in. I'm not going to read out the whole of his email, but essentially he runs his own business and he's managed to save £10,000 to try and start investing. And he's been listening to the podcast of being you. He loves it, which is great. But he wants to start looking at investing, getting into it. And his question is, I was going to just invest in one, either the FTSE 100 or a single company's shares. I've had a look online. I think Barclays have the best account for stocks and shares, and I want to have a go myself without a financial advisor. Do you think this is wise? I'm heavy into research and believe I can find any information I need online. If you can help in any way with a little direction, that would be great. So, a novice investor full of enthusiasm who loves a bit of research and wants to start investing. That's fantastic. I mean, if he understands the risks and the rewards, then why not do it? My personal advice is I would never put £10,000 into one investment, particularly into one company. It's putting all your eggs into one basket. You're betting on the fortunes of one company which you are unlikely to know all the ins and outs of despite any research. You can find the company's accounts, you can look at their balance sheets, you can see what's out there, but you've got the potential to make a lot of money. Of course, shares can jump up and down 10% in a day, but you've also got the capacity to lose a lot of money. So I would advise personally against doing that. I much prefer investing via funds. It's a get rich slowly mentality. So a fund will be run by a fund manager that has 50 to 100 positions in different companies. You can hold multiple funds, which is what I would do to build a portfolio. So for me, I wouldn't suggest you do it. If you wanted to, then you can go and do research. You're going to probably have to pay for the best research, which is also a problem. That will eat into your profits. You could look at sites like Motley Fool that will have recommendations. They run articles on things to buy. But would I buy a FTSE 100 tracker instead? Again, it's the fortunes of the UK stock market. It's more diversified, admittedly. But I would probably buy a globally diversified stock track if I was going to do that. There's plenty out there, the MSCI global indexes that run in ETFs, or you could just go and buy something like one of the Vanguard funds. They run life strategy funds which are very good, that have very well diversified, and you can get different versions. So my advice is I wouldn't like to be overexposed to one stock. I know why he's doing it. He's trying to perhaps boost his returns, but I think it's got too many downsides for me. The next question is from Gavin, who recently opened a Vanguard account. Oh, he's mentioned Vanguard there. And he's bought a particular fund, which is one of the ones that's got a more of a retirement focus. And he's just added a FTSE 250 element. With recent events, I've become a little spooked. With all this in mind, would you say someone at my level it's best to hold my nerve and stay the course, or is investing perhaps not the correct choice for someone with little disposable income? I'll focus on the last part. Generally speaking, if you don't have much disposable income, then investing may not be for you. To be honest with you, the general advice which the FCA condone is that you should have around 6 months wages saved up as a buffer, cash buffer if the worst goes wrong. So you lose your job or something like that, you can fall back on. So I would say that if you don't have that and you have very little disposable income, so you're living a bit more hand to mouth, then investing is probably not for you. To be honest, you probably need to have more so you can survive if the worst happens, because don't forget, if you invest in a FTSE 250 tracker, then that is going to go up and down, especially with Brexit, because FTSE 250 stocks are more exposed to the UK economy. And so, depending on what happens with Brexit, I mean, Brexit's a lottery at the moment. If we have a no-deal Brexit and our economy implodes like the Bank of England was suggesting in their worst-case scenario, well, FTSE 250 stocks are going to be doing very badly. The FTSE 100 won't do great, But if the UK currency, the pound, collapses, it will at least give it a bit of a boost. It does tend to give it a boost because the earnings are derived overseas for about 80% of the companies in the FTSE 100. So I would say if you're on the low income, investing is not necessarily not for you, but you could drip in small amounts that you can afford. But I would suggest you build up a buffer beforehand. As for when markets tumble, that is a natural thing that's going to happen if you invest in an index tracker. So when I did the Steps to Investing event that we mentioned last week, there's nothing wrong with admitting that when markets fall, that spooks you and you're going to have sleepless nights. That is a sign that you're either A, taking too much risk, in which case you should reduce it, or B, that investing isn't for you. There's nothing wrong with that, so just admitting it. So there is a sign there, I'd say, to Gavin, that if he's really worried about it, then he's either taking too much risk or he shouldn't be investing because it's not really for him. Then stick to something like cash. That's fine. You don't have to do what everybody else does. The other thing I would say is, obviously, when markets go down, they can go up. Who knows where we're going with this market? We could be entering a bear market. We could be about to rebound back to all-time highs. They're the risks that you take. There's one thing that's been shown, that the biggest rallies in stocks tend to happen after the biggest losses. But that's not to say that the rallies recoup those losses. They're just bigger rallies. So you could have the market fall 10%, but it rallies 3 or 4% in a day. You're still down over 6. So that is something you just have to accept if you're going to be investing. That's it on investing. We're on to the last piece, Andy. I'm conscious of the time.
Excellent. So yeah, moving on to the last piece, the piece we've been promising. It better be good, Damien. We've been promising this for about 3 weeks. So we're going to be talking about flights.
Yeah, I do feel like it's had a bit of a build-up for something that I'm going to probably rattle through in mere minutes. But flights, Andy, if you're thinking of going on holiday, given the terrible weather at the moment, you probably can hear the rain drumming on the roof of where I'm recording this week's podcast. But the idea of flying away from it all is quite appealing. But there was some research done that to sort of look at some of the myths that are out there about booking flights online, and the first one that they were looking at was about the idea of this cookies. Your cookies, Andy. You know this story that if you search for a flight and you don't buy it, and you search again at a later date, your cookies the website will know, and therefore start putting up a higher price because they're starting to work out that you're probably going to buy. So they're sort of inflating the demand to get you to buy something at a higher price. Now, the research that was done was, I forgot now, because it's been so long, I forgot which paper it was in. I would credit them, but it's been weeks since I read it. They suggested that wasn't true, but I've also seen evidence to suggest that it is. So the jury's out on the cookie thing. So you can clear your cookies if you're worried about it. So do that anyway when you're browsing online.
Most men are absolutely aware of how to clear cookies. So
well, I'll tell you what, Andy. We're going to come on to something in a minute. VPNs, which is a whole another story. The next myth is that if you find a deal on a comparison site, so we're talking the likes of Google or Skyscanner, then if you go directly to the airline, you'll get it cheaper. That's been shown to be a myth. You actually won't necessarily get it cheaper. Often, it is cheaper still to go through the comparison sites than the site directly itself. So that was a bit of an eye-opener. Now, when you're looking, there's a number of different comparison sites out there. Google has one, there's Skyscanner, there's Momondo is another one where you can search for flights. But the research shows that Skyscanner is the best at finding the cheapest flights. I mean, we're not talking massively, but it was, when they did their tests, I think 40% of the time it actually found the cheapest flights. So it's marginally better than the others. So if you're going to look for flights, have a look at Skyscanner. Airfare. Now, this is where there's an error put up on a website for the price of a fare. We've all been there at some point. We've seen some ridiculous deal online for something like a computer. We've all rushed to buy it to try and take advantage of these price blips, and normally it doesn't work. But the airline industry does also make these mistakes. But you can find them. There are sites that track these and will notify you when they exist. So Fly for Free, so Fly 4 with the number 4 free. You can sign up to alerts with them and they will tell you where these blips are, so you can take advantage of price glitches. Presumably you end up going somewhere you might not necessarily have predicted. But the next myth, the number 4, is that all search engines compare all airlines. They don't, so therefore use a number of them from the ones that I previously mentioned. And the fifth one, which is where I'm going to get onto VPNs, is spoofing location. Now, anybody who doesn't know what a VPN, it basically hides your IP address and what you're looking at. So if you wanted to look, let's be blunt, if you wanted to look at porn, you wanted to hack people, you wanted to do all these things and no one know what you're doing, not even the search engines, you can get software that blocks your VPN or hides your VPN. It's a virtual network. And all it does, from your point of view, when you turn it on, you can just surf as normal, but no one knows what you're doing. There's no evidence of it. Now, I know that sounds very much like a man who sat there and looked at the... Why does Damien know so much about these VPNs? I can see Andy's smirk on his face. He was about to say it. I'm going to nip you off at this. The reason I know about VPNs is also because if you work remotely, like I used to do in the early days of Money to the Masses in coffee shops, it stops anybody being able to snoop on what you're doing. So if you go onto a public Wi-Fi, so if you go into Starbucks and you start using Starbucks' Wi-Fi, and look at your emails or your banking, then technically other people using that Wi-Fi network are able to, if they're clever enough and they're so inclined, could intercept what you're doing, and therefore you could expose yourself to hacking. So if you have a VPN, they can't do that. So I've used them in the past because they're very useful. They're very cheap actually as well, so they're good if you're travelling. If you go travelling, they're great because it means that you could go onto a hotel Wi-Fi and happily, if you turn it on, because it anonymises everything, you can happily do your online banking on the hotel Wi-Fi if you've got it turned on. So that's how good they are. But going back to what I was talking about, there have been ways of people, because you can choose where the internet, where they think you are. So if you turn it on, you can appear that you're in Luxembourg or in Australia.
Yeah.
Now, what that means is that there's evidence to suggest that airlines will give different pricing to people based on where they're buying it from. And so there's been shown that if you use a VPN and you set your location so the website thinks you're in a foreign country, you can get the flight cheaper than if you admit that you're in the UK. So it's called spoofing your location. Some people have saved hundreds of pounds. But there is a caveat that how does that actually impact whether you've bought it and you're using it from the UK? Are there any sort of T's and C's that it sort of exclude you from travelling on the ticket? That was the caveat that was in the piece of research. So if you do it, check the T's and C's to make sure that you're not going to be stopped at the gate. How they would know you did it, I don't know. But anyway.
Good. We're done.
We're done, Andy.
Excellent stuff. We're done. So if you would like to get in touch with Damien, please do so. You can on email, of course. It's damien@moneytothemasses.com. Twitter is @moneytothemasses with the number 2. And of course, search him on Instagram. There's lots and lots going on Instagram. And keep an eye on Damien's Facebook and all of the socials in the next few weeks, because as Damien said at the start of the podcast, there's very, very exciting stuff coming up in the next few weeks. And as Damien alluded to, a brand new website coming soon too. So exciting.
And I want to just throw something else out there for people who've stuck around and listened to the ending. That in the new year there'll be a new podcast, and it's going to probably more likely be a midweek investing one due to demand. If you like the idea of that, tweet me and say hell yeah, we like that. So we make sure, we've mentioned it before and people fed back on our meetup, people suggested they like the idea of it. But what we want to do, because this podcast is try and make it evergreen, because like one of the I forget which were the chaps who I just mentioned in the questions was so far listened to our back catalogue and had got back to something like 115. So he's already listened to about 100, almost 100 back catalogue episodes, and that's what I love about doing the podcast in an evergreen fashion. But there is a scope and almost a need for a contemporary one on investment markets, and I think people would like that. So that is almost certainly coming in the new year.
Wow, exciting stuff. So until next time.
Don't forget to claim your free copy of Damien's best-selling book, The 30-Day Money Plan. Sort your finances in just 5 minutes a day, worth $4.99. Just go to moneytothemasses.com/podcast to find out how.